outstanding contribution to the banking sector. Moving on to another panel discussion for the evening titled Smart Lending in the Era of Tightened Norms. The concept of smart lending has gained significant traction as institutions navigate a complex regulatory environment. The era of tightened norms present both challenges and opportunities, pushing financial entities to innovate and adapt their strategies to maintain resilience and growth. And to explore how key players in the lending sector are responding to these challenges, may I please invite CNBC-TV18's Prashant Nair to moderate this session. May I also invite the panelists for this discussion. First up is Raul Rebello, Managing Director and CEO, Mahindra Finance. Vyas Chakravarti, Managing Director and CEO, Shriram Finance. Jairam Sridharan, Managing Director, Piramal Capital and Housing Finance. And Aseem Dhru, Managing Director and CEO, SBFC Finance. Over to you, Prashant.
Thanks very much, Shruti, for that. Mr. Srinivasan, fantastic chat and I mean, really enlightening and inspiring. If you're there in the room, I can't see you right now, but really lovely and inspirational sort of conversation for all of us here and big learnings. Thank you very much, gentlemen, for being here. We've heard about banks and we've sort of heard from banks about the challenges and aspirations, etc. So here is a really sort of top-notch NBFC panel. I want to say a few things before I ask them questions. The total, I was just sort of doing the numbers, the total AUM managed by these sort of four gentlemen sitting here is, I think, not worth of 4 lakh crores. You know, I want to put the pressure on Jairam straight away. Last time we did this event here, the same event, Jairam gave us a really super headline. He called out the stress in the unsecured lending segment. And of course, we ran with it. And a month later, a month and a half later, Jairam, was it? You know, the RBI came out with the regulations where they increased the risk weight for lending to NBFCs. So, I mean, I'm hoping you'll give us another one. But not just you, I mean, others as well.
मेरी काली जुबान को तुम remind मत करो यार लोगों.
No, but you know, so I want to just touch upon 2 or 3 things really on this panel. One is, of course, funding. We've heard from banks and most banks here that deposits are a problem. So if it's a problem for banks, it is a problem for NBFCs because NBFCs are wholesale funded. Second, of course, is you know what's happening to asset quality. Again, you know, FY24 exit rates on asset quality was absolutely fantastic. I think that number of 2.8% system-wide NPAs, I mean, the lowest ever. So there is a bit of cyclicality. It should go up, but I mean, are there other issues involved as well? And the third sort of aspect I want to touch upon is regulatory action on the record, mostly here. So let's kick it off. Mr. Chakravarti, why don't I start with you? Is funding going to be a problem for NBFCs? I mean, if you look at FY24 and bank advances, it was what 22 odd lakh crores. If you look at estimates for what the overall system credit will be in FY25, it's expected to be lower than what, I mean, in terms of absolute net sort of credit of the banking system. So in that sense, there is less water in the lake expected to be. What does it mean for NBFCs like yourselves and others?
I don't know. So far, whatever I've seen, the banking sector has not slowed down their lending to NBFCs as of today. So I'm not sure going forward whether it will happen. But one thing for certain is the smaller NBFCs are finding it difficult to raise resources, which is very unfortunate. One point. The other point is, again, as I said, deposits. When we are we have a deposit taking license, but our deposit is growing at around 20%. Most of the private sector, I mean NBFCs who have a deposit taking license, the deposits are growing. But the other side also, I don't think, I mean, I'm sure my colleagues here also will support that we do not see any overt pressure on liquidity as of now. But fact is, the smaller NBFCs, yes, they are finding it difficult to raise.
Got it. Jairam, you want to weigh in? What are your thoughts?
See, I think Mr. Chakravarti and many others are blessed to have deposits as a source of funding. अब तुम अमीर आदमी को इन्फ्लेशन के बारे में पूछोगे तो वो तुम्हें क्या बताएंगे? हमसे पूछो. There is not a challenge in terms of availability of money, but there is a pricing pressure. The fact that liquidity is low in the market has essentially led to banks essentially saying, इतना रुपया आपको लोन दे रहे हैं, ये रेट है, टेक इट और लीव इट. पहले जो नेगोशिएशन पॉसिबल थी कि भाई I'm borrowing from another lender at X price, so I'm going to negotiate down to that X price, etc. The bank now says, boss, this is the price. You either take it or you can walk, because I've got only so much limit of how much I can lend to NBFCs, and utne ke liye to log line mein lage hue hain, right? So it is, I think, a pricing pressure right now. Lata earlier was asking the question on margins, and what Mr. Vaswani said about long term kind of, things all look bright, and of course in India long term hamesha bright hota hai hamara. But in the short term, there is no doubt that the deposit crunch leads to margin pressures across the system. Mathematically, there's just no other way, for it to not happen. It will show up differently. The economy is a caterpillar. Some places will be compressed and some places will be elongated. And it will show up in different places. Right now, from an NBFC perspective, that is showing up as margin compression. And you saw some of that in the first quarter results. You'll see more of it in the second quarter results. And I think it is something that we need to be aware of. But availability of money for the medium or large guys is not a problem. The smaller guys are really struggling in terms of access. The really small guys are really struggling. You're seeing that in fintech NBFCs. You did not hear that in the GFF. Right?
We have a fintech panel next, so you probably will hear some of it.
Please ask them. There is all the fanfare aside, from an actual lending perspective, fintech lending has significantly decreased over the last year. There's no doubt about it. And while credit risk issues are one part of it, liquidity is also a driving factor there.
Just to add to that, I think one positive for the small finance companies is one of the senior banker from a public sector was telling me, why would I lend to you? I'll get a good rate, so I would prefer to lend to smaller finance companies. So there is also that side, the bankers are also looking at better margins if they lend.
But in any case, there is margin pressure. I mean, for those smaller guys then, right? I mean, at some, it shows up.
Definitely.
Aseem, you want to weigh in? I mean, your thoughts?
So to take the early analogy forward, that these gentlemen are on the table, I am the one in the menu. So see, if you actually see this structurally, 40 trillion is the total borrowing that NBFCs and HFCs do from the system, of which about 55% comes from the banking system, 45% comes outside. Of that 45%, 12% comes from pension funds, etc. About 13% comes from insurance companies, and about 8% comes from mutual funds. So already 45% of borrowing, and then 6% comes from ECB. So these are the broad sources of borrowing. Now, we have to see that if you are rated AA and above, then entire 100 is your menu. If you are rated below AA, then your menu is that 55% bank, because the NCD market is not really open to you. ECB is out of question. So, I mean, how is the world? It's an elephant story, a blind man and elephant story. It will appear very different depending on who you ask and what is the view from that point of view. So yes, in short, I would agree from what both Jairam and Mr. Chakravarti said, that it is not availability of credit as an issue. The cost of credit is going to be an issue.
But some of the larger guys have also raised ECB money, right? I mean, so that is also happening. So availability is there,
not available to below AA rated companies.
See, of all the instruments that are available for an NBFC to borrow, a AAA has access to all of them. A AA plus has access to maybe a tiny bit less, and A has access to a little bit less. For example, as a AA player, I cannot access at size, I cannot access the domestic bond market, right? Because it's just not open. But a AAA guy can. Now, but I can still go and do an ECB. Below a AA, even that option is a little bit less. and so on. So number of instruments available become lesser and lesser, and you get more and more dependent on banks as you go down the size, I think is the point that Aseem is making.
Raul, please weigh in first thoughts. Has it been an issue for you at all, what we're talking about, or no, not yet?
So since Jairam talked about blessings, I should show some gratitude here. Yeah, we have a deposit-taking license. We are AAA rated. And we also have something which today everyone is hungry for, which is priority sector. Right? So you add these three up and I can't complain. But it's important to be diversified. As bankers and lenders, you want to be diversified on the asset side. But especially at our shop, we have not had a very good deposit franchise. So a lot of my time goes in not just looking at cost of funds, but how granular your liability book is. So there's going to be margin pressure. I'm sure we're all seeing that. But otherwise, I can't complain too much on this stage.
Where are we? I mean, Jairam, you said that it's already showed up in the first quarter. So, I mean, are we early in and we'll see a lot more of it? I mean, is there any way to tell at this point?
I don't know. My guess is that Q2, there's a lot of AUM here, so I shouldn't say things which are proven wrong very quickly. But I do feel like Q2 is going to be the bottom from a margin perspective. Things should start looking up. A lot depends on what happens in the policy environment, and if some easing starts happening, and how long it takes for that easing to start showing up in lending rates. But see, the liquidity was way tighter 2 months ago than it is now, and hopefully it stays that way. Hopefully, I mean, it's not an excess liquidity environment, but it's not a very deficit liquidity environment either out there. So hopefully things stay that way for a little bit longer for pricing pressures to ease. And if regulatory action happens, we saw what the Fed said recently. So hopefully that translates into some action on the RBI front as well. And if it does, you might start seeing some easing on that situation from Q3 and beyond. But Q2 does not look like it's going to be, it's going to see any improvement if it's going to go further down.
I mean, it's predicated on a Fed cut, then RBI is starting to ease, basically, right?
I wouldn't say the then in between. I mean, RBI might do things before the Fed does. But yes, there is obviously a close correlation between the two things.
Got that. Let's talk about the other sort of part of the conversation, which is asset quality. Again, we exited F524, absolute pristine asset quality, not just banks, but NBFCs as well. Q1, we started to see some stress. Where are we and what are we seeing really, Mr. Chakravarti? Because, I mean, you have your, you operate in many segments now. You're not just a truck financier. You have, you operate in practically all segments. So what are you seeing?
Actually, if you look at the market-wise, whatever stress we have seen, a little stress, is in the urban markets. The rural and semi-urban, most of the business are performing well. The products that we are into are performing well. We have seen a little stress in this SMEs, particularly small and micro businesses in the urban environment. But otherwise, in fact, the first quarter we've done, touchwood, we have done well. And so far, second quarter is, we are in line with what we have done, numbers in the first quarter. So basically, the urban environment is something there where I'm seeing a little stress, but not on the rural side.
Raul, you agree with that? You have a fair bit of sort of rural exposure as well. What's your sense? Is that holding up well, or are you seeing some stress there?
See, the customer segment, which is depending on one source of income, that definitely sees some more stress. So, quarter one versus Q4, you have seen everyone go up a bit. If you look at those customer segments, were totally kind of their fortunes were linked to the agri income. Yes, they were slightly more stressed, at least for what we saw, and tractors see some kind of jump in the first quarter. But I think at a headline item, I don't think there's any alarm bells ringing, because we had two crises in the past, and I think at a household level, what we see is inherently households have tried to diversify their household income. If there are 2-3 generations, they're trying to even up the game in terms of their overall resilience. So I don't think alarm bells at all. But yes, there was a slight blip in some segments. And see, Q1, typically for a player like us, we have 85% upwards of self-employed non-professionals, right? And the elections did cause some bit of a disruption. And we had some extreme heat waves, and in the east, some early rains. So Q1 typically has some disruptions, but I don't think we can call the rest of the year right now.
There was an analyst who we spoke to recently. He counted, I mean, I think his team counted the number of times elections and heat waves were mentioned on earnings con calls. And it was, but yeah, we've heard that.
Always mention things that can't be measured.
But Aseem, you wrote a post recently, and that went pretty viral, talking about sort of the crowding in on retail, because corporate lending is not really, the only game in town is retail, and how that perhaps raises risks. So just sort of explain that point in the context of asset quality and what you're seeing.
See, trouble with averages is that you can drown in an average 4 feet of water. So the problem is that we have not yet accepted the fact that post-COVID, the K-curve recovery is very real. And what has happened is that while some of the people have done very well on the upward end of the curve, a large part of our population is battling inflation. And what has happened is that incomes have not really kept pace, and lifestyle expectations have changed. So to fill the gap, people have excess credit to fill that gap between the life they want to live and the life that they actually can afford to live. If you look at what happens is that look at what is the total record CIBIL has. About 145 trillion is the total borrowing that people have done on the consumer side at a consolidated level. Now, if you see what happens is that there are about 8 crore people in the country who file a return. 3 crore people pay any form of tax, and about 45% of the tax comes from just 1 crore people. So that's the math. Now, who do you think the entire 145 crore lending majority is going towards? You take out the 3 trillion lending that happens on microfinance. You take out some amount of SMEs, commercial vehicles, all of that at the bottom end. A large part of the lending happens to this taxpayer community, because banks generally lend to that community. So effectively, what is happening is that there's the layering happening. Now, if you look at microfinance, for example, the latest Pulse SIDBI report basically states on the first page that the AUM of the industry has gone up by 22%, and number of customers has gone up by 6%. So effectively, when you do the math, it clearly tells you that we have possibly, the party has got extended a little too late, and there is going to be a little bit of a bill coming. We have gone to one extreme of credit quality, and now we will swing a little. I don't think that there is cause of panic. I don't think that people need to really read too much into it. But have we really, from here, do we really see a 10-20 basis point increase in credit cost? Possibly yes.
But no blowout in that sense. I mean, just a.
No. So see, one of the good things that between us and the regulator, it is like the dog and the vet. The dog will complain even if the vet is doing what's right for the dog. But the reality is that they have made the system safer. So whatever were the bubbles that were identified, so for the first time, see, as a banker, when I wear my previous hat, for the first time in the system, I do not really find excesses and I do not find risk. If I was a lender to NBFCs at this point of time, I would not be losing any night's sleep. So the system has become a lot more safer. And if you look at capitalization, every lender today is beautifully capitalized. Leverage level is probably at its lowest ever. So when people are making good return on assets, good return on equity, on low leverage, and great capital, I don't think there is a systemic risk. It is just that when it hits, a few players may have to take a little bit of adjustment, and it is always it's a tripod. You are balancing growth, you are balancing ROAs, and you are balancing asset quality. So in this tripod, sometimes last year was the time it was perfect. It cannot be perfect. I mean, last 10 matches, Tendulkar has scored a century. What is the probability of what happens from here on?
Yeah. No, absolutely. A point taken, well explained. Jairam, on asset quality, what are you seeing? On the consumer lending side especially.
Yeah, so let me take one of the points that Aseem made. Let me just try and take it forward. This point about leverage. I think leverage is a real issue in the market. Here are two statistics that kind of stun me, honestly. Of all the applicants for credit, unsecured credit, in the market, 10% have more than 10 live unsecured loans right now. Of all applicants, 10% of them have more than 10 live unsecured loans. How crazy is that? Who would have thought that anybody would be running 10 unsecured loans? 10% of the applicant population is running that today. Here's another statistic. Everybody who's applying for digital loans, right? You should ask this to the FinTech panel next. Everybody who's applying for digital loans, 50% of those applicants have more than 5 unsecured loans open. 50%. This is not normal. This is not the way lending works. This has not always been the case. It is new. Something new is happening in front of us right now. Now, of course, people will argue out that these are not really loans. These are small, kind of this BNPL type stuff. That's not really lending. That's just payments, shush. But we don't know how this works. So what we are seeing today in terms of absolute levels of leverage are not good. When you look at it from a historical context. Now, having said that, the numbers, when you look at pure delinquency numbers, etc., they have ticked up a little bit from when we last spoke, but really nothing has really blown out. It doesn't look like a big impending doom has come in. However, one needs to wonder how much is that related to this high leverage problem. The fact that people have so many lines open. I don't know how much of that line is actually going to pay some other line in the previous credit that you just opened. So you asked kind of, or in the previous panel as well, there was this question about kind of where are we headed, and I think Lata asked the question, is the best behind us, or is the peak behind us, or something like that. I think the best in terms of asset quality is almost certainly behind us. There is no doubt that things, or tomorrow is going to be worse than today. Now, how much worse? And we don't know. But the fact that this year is going to be worse than last year, I don't think people would disagree. Or certainly the numbers won't disagree. You will start seeing the numbers, and you're seeing some already. So that's broadly where I stand. I do not think, I do agree with Aseem's point that there is nothing that indicates a big blowout yet, right? Because the problem is happening in a segment of the population which is 8-9% of the entire segment. If you dig deeper, even smaller. But the fact that there is a leverage problem in the industry, in my mind, is unquestioned.
And is the guy with the 10 loans getting the 11th loan, and the person with the 5th loan getting the 6th loan, or no?
That's the applicant pool. Thankfully, the disbursed pool actually looks a little bit different. So It does look like somehow the credit criteria of lenders is catching some of this,
right,
and is giving the highly levered people slightly less credit, but it's not zero. So that proportion of 10 plus is not becoming kind of much lower anytime soon. I will say though, and there is something to your question, I will say that if you look at that same number 3 quarters ago, that number was even higher. Right? So there is a downward trend in that high leverage number, because I think more people are realizing that there is a leverage problem. But in absolute terms, it's still a very high number.
Got it. Let's, Aseem, you want to add something?
Also, Prashant,
Yeah.
one thing you have to keep in mind that हमारी हालत ये है कि काजी दुबले क्यों, पूरे गांव की चिंता.
Sorry, repeat that.
काजी दुबले क्यों है, पूरे गांव की चिंता. So the reality is that because you are standing from a point of vantage where you are looking at the entire economy and various constituents, you are always more worried than the borrower about the borrower's ability to keep paying you over time. So in a way, it is good if we are worried. If we are not worried, then all of you should be very worried.
Oh, that's very well said. One quick round on the last sort of bit that I wanted to touch upon, which is the regulator. And, their actions have been widely appreciated. They've been putting out fires. We've heard that before sort of they spread. I just wanted your thoughts. I mean, what would you like to see? I don't think we have the regulator in the room, not anymore, but so maybe you guys can be on the record a little more. Raul, you want to start? What would you...
Yes, let's talk about the regulator on camera. That would be fun.
Go on, Raul.
Yeah, can you switch off the cameras and recording now, please? Well, I think the three big things, the scale-based regulation which applies to, 16 of us, significantly kind of takes the compliance levels, and I think there's no more arbitrage between us and a bank anymore, which is good. I don't think we need to complain there. It just helps us sleep better at night, know that there's more stability, and, the control functions step up is pretty significant. I think so, no complaints there. For someone like us who's been typically a traditional lender, single line, and now trying to diversify, I think facts that the whole digital lending guidelines have come in and made it much more predictable and set the rule book in place again is pretty good. The third big thing, if I were to look at, is the whole risk weights. Yes, we talked about it. It does have it has an impact on the quantum of funding and margins. But overall, I don't really, at least you'll have different answers from all of us here, but from our vantage position, it's not something that we could complain about.
Aseem? I'm not looking for complaints. I'm just looking for feedback and
See, financial sector are naughty fellows. So if we are given freedom, we will tend to, in the pursuit of profit, overstep boundaries. That is the nature of the beast. In fact, I would highly recommend a book called All the Devils Are Here. In case anybody has not read it, please read that book. It is about how the US system arrived at what it did and what the players were up to. It was fantastic. There the entire regulation fell behind the curve, and the innovation went way ahead. Here, at least one thing we can't complain, that the regulator is actually ahead of the curve, and we are trying to keep pace. So we may complain, but for the system, it is very good.
I mean, you gave the example of the dog in the wet earlier. I think that's something. Jairam, you want to quickly weigh in?
I agree with most of the points that Raul and Aseem said. I do think the regulator has been forward-looking and appropriately conservative in different pockets. They do end up sometimes getting the wrong end of the stick, as we heard from Mr. Swaminathan earlier today, in terms of being deemed a little bit trigger happy was the word he used. So there is a little bit of that you hear. That's. Anybody on whom you take an action is always going to complain about that. So it's not there's not a whole lot you can do on that score. What I think the regulator has slowly been moving towards, and we would love to see a lot more of as well, is more sort of principles around which regulations operate, and sort of prescriptions, which have been the way that a lot of regulatory guidelines have worked in the past. Maybe the sector is getting to a point of maturity where we can move a little bit further away from highly prescriptive towards a more principles-based regulatory environment.
Gentlemen, I wish we could go on, but we're completely out of time. Thank you very much, all of you, for being here. We have our next session ready. Mr. Chakravarti, Jairam,